Just dwell for a moment on the period that you've reported here then, and the unexpected size of this loss, and then maybe give us a snapshot on current trading.
Sure. So as you said, the COVID losses for the group for the full year are very significant, $3.9 billion. The fourth quarter addition to those losses was probably a little higher than people anticipated. This reflects, frankly, the second or third wave, depending on country, that we saw in the fourth quarter in many Western economies, and the unfortunate resulting increase in caseloads, but also deaths that we've reserved for in the fourth quarter. Overall, we think the worst of the COVID losses is well behind us. We've given some projections of what we expect in 2021 with respect to our property casualty book, less than $500 million of additional losses to be anticipated there. With respect to the mortality and the life and health re business, it's going to frankly depend on the success or lack of success of the vaccination campaigns and the bringing the overall pandemic under control.
And John, the Olympics in Tokyo seems to be material as well for Swiss Re in terms of exposure. What are the odds now that this event gets cancelled and that you will have to pay out?
So we don't have specific odds on this or other events. What we have noticed and obviously observed is that lots of major events are moving forward as we speak today. We've got the Australian Open moving towards its final. That's very different than the case last summer where Wimbledon was canceled and we actually had a loss related to that. So with respect to the Olympics, but also other events coming through in 2021, we've made some estimates of what we expect to happen as we suggest that we've got an additional $200 million of losses coming from cancellations during the course of the year. We hope the Olympics goes forward, first for the athletes, second for the populace in Japan, and third for the world. If it doesn't, we'll manage it.
John, I read your Sonar report about global risks, and the Sonar 2020 laid it on the line really last year, just how many risks there are out there in the short, medium, longer term. I don't see how your industry can price those risks effectively when the industry is awash with tourist money that wouldn't normally be in the insurance sector. How do you raise premiums accordingly when there are so many risks but so much money sloshing around?
So it's a great question, Jeff. What we've seen is on our January 1st renewals, with the portfolio that we wanted to write, we were able to raise rates by 6.5%. That's provided us with a stronger portfolio in P&C Re, and we think our combined ratio, the core measure of the quality of the book, will be further reduced below 95 for the year, is our estimate today. We think that the long-term capabilities of Swiss Re, we've been in business for over 150 years, people trust us to be around for the next 10, 20, 30 years, will be a differentiation factor for the way that people think about bringing Swiss Re onto their account.